but if I don't give you users, probably you won't have the transaction unless I mention to you. So, but if I give it to you, you divide that by 7, consistent, so you get your fees. So EBITDA minus depreciation minus fees, you get to an EBIT, and then for DCF purposes, you don't subtract any interest. Interest is 0, it's unlevered. You get to an EBT. Then your taxes, basically taxes is percentage of that. And then you have depreciation, amortization, adding that back, it's a positive number. And then you have a working capital, which in this case is 1% of revenue. So 1% of 40 is 400,000. And then 3% will be a capex of 40 will be 1.2. You subtract all the expenses and add all the positive stuff like depreciation, and you get to this cash flow financing. And then you come and you put in the financing obligation, which if you remember, this comes from up here that you added. So subtracting that, you get your equity cash flow. So you're almost there. The only thing you have to calculate terminal value. Terminal value is a little tricky. The first part will be an EBITDA multiple. So in this case, 6 times multiple that you have to calculate, and I'll tell you in a few minutes, times the EBITDA that year. So EBITDA grew to 25 million from 20. So 6 times 25, 525, it gives you 153. That's the enterprise value for the exit year. Now the 6 times represents, if I don't give it to you, the multiple of the purchase price. So I guess 123, I guess divided by 20. It's a little more than 6 times, but I will either give you 6 times or I give you the multiple that the company is buying, okay? And so just look for that, the multiple, I guess. Either I can give you 6 times or I can tell you how much they pay and what was the EBITDA at the time when they paid. So if it's 20 and they're paying 123, 123 by 20 is like 6.2 or something. You will use 6.2, okay? The next thing is the other method is called perpetuity method. Perpetuity method, you have to use the WACC. Remember that 9.84 represents the WACC up here. So here you have that, and you're going to have some kind of growth rate. I'm going to give you 0% growth rate or some growth rate. So the way they calculate the terminal value is next year's cash. It's important the cash is before debt service. So you get 15,536 as your numerator, divided by the WACC minus the growth rate. So I get to 245, okay? And look at the formula. If you don't get it, get to the formula, get in, and we'll see that. The average between the two, you get a 199 terminal value. You subtract the debt, and that debt, if you remember, you got down to 45. You started at 77, and it gets paid down at the X years 45. So enterprise value minus the debt, you get to an equity value of 154. That represents how much you will get when you sell the company after you pay down the debt. So now you drop off all the cash flows from the top, and you see 2 point drops down, 3 drops down, everything drops down. And the last year you have to remember to add the 154 to the 188, 1.818, and here you will have a cash flow. If you put the initial equity in here, negative, it has to be negative. If you do positive, you're going to get an error on the IRR. That's my initial investment, and this is what my cash flow is going to be coming back to me. So if I invest at 43 negative and all this positive, what's my return? Now 43.6, you remember, is from the sources and uses, is part of the I guess up there, okay? So if you do an IRR, which is equal IRR, and you highlight the whole thing, you get 27%. And then I'm going to ask you for the NPV. NPV is basically the present value using the expected equity of 20%. Remember the CAPM 20%? So if I do 20% present value of each of the future, and you add all them together, you will get 61 million, which is higher than 43. 61 minus 43, I get a positive net worth. Sorry, net present value of the equity. So now you're done with the second question. This is how it looks, the Alexandria Hotel. Okay. Then we're going to the third section, And the third section is basically two questions. The first question is going to be from this spreadsheet. This spreadsheet is on the May 9th lecture. And if you look at the May 9th lecture, there was one spreadsheet, you open it up, and it has a lot of methods. But I want you to focus on the Black-Scholes valuation and call option. And we did that last week. Basically, I'm going to give you all this data: standard deviation, expiration years, the T, risk-free rate, stock price, except by the S, the X, and the dividend yield. Probably most likely I'll give you 0 dividend yield. Okay? And I'll give you all this data. And then you have to calculate D1, D2, normalize D1 and D2. So go to the formulas here and master how the calculations are done. Now D1 is a big, long formula, and I have it here. So I calculate this part is the logarithm S divided by X. I calculate this part, which is the interest minus the delta, the dividend, S squared sigma second part divided by 2, and then times T. Sorry, I forgot the T here. So times T, and then you have the sigma squared times T. So you do a calculation of this plus that divided by that. And you get your ND1, ND2, ND3. And then that's how you get this Black-Scholes. And that's about 10 points. Hi everyone again, this is the second part of the video. Looks like my first video ran out of tape. I guess 20 minutes I allowed it to take video. So this is the second part, so we'll continue from here. This is the second question of section 3. And basically it's on the same spreadsheet, which is dated May 9th. So the May 9th lecture has the same spreadsheet as before. And zeroing on this first method, method 1, how to calculate call option using the binomial pricing model. There, I'm going to ask you, I'm going to use some information. So you're going to get the stock price. I'm going to give you the stock price, okay, 100. Then I'm going to give you the exercise price. I give you the exercise time a year from now. So you're betting that the stock is going to be 110 a year from now. It's 100 today. And there's a 10% interest, which you're going to use later for the binomial pricing model for present value purposes. Then I'm going to give you the up and down factors. If it's a factor 1.2 from 100, so the upper limit of 1.2 times 100 is 120 bucks, and the lower limit is 0.9. So from that level, the stock can go down 0.9. So that's 90. So the first step, and I put all the steps here, you can tell. First step is to find the range of the upper and lower. So SU, which is the stock up, and minus SD, stock down, you get to 30. Second step, you have to ask yourself, you're going to find the call option up and call option down. So the 10 represents how much the payoff will be if the stock ends up at 120. Basically, if it ends at 120, you will exercise because, remember, you locked in the 110 price future. So at 120, you made a $10 difference. That's your payoff. So that's your $10. If the stock goes down to 0.9 times 100, so $90, well, if you have a call option, that's bad for you. You won't exercise. So there's no payoff. It'll expire. So 10 minus 0 is 10. So the second step is to find the range of step 2. The range of the exercise, payoff. So basically 30 and 10. And then you find this little h. The little h actually is taking the range between the call option up and call option down divided by the range of the stock up divided minus stock down. So 10 divided by 30 is 1/3. So 1/3 is your h. The next thing you have to do, since we're dealing with call option, always remember the worst case scenario. If you call option, you don't want the stock to go down. So what you do present value of the lower amount. It's called a borrowing. You're borrowing at the lower amount. So present value of 90 using 10% in 1 year from now is 81.82. 81.82 presents a present value today. What do you have to borrow today to get 90 a year from now? Step 5 is to actually take the $100 today minus the present value of the future stock down. So that's 18.18. and then you take the 18.8, the last step, multiply that by the h. And h, as I mentioned, is 1/3. So 1/3 times 18.18, 606. 606 represent the premium you have to pay given all the parameters of expecting. And that's one of the questions you have to get. Now I added another factor here. What is your break even? Break even is easy. Obviously 606 is the premium. 110 is when you lock in. So 110 minus 606. The stock has to go higher than 116 for you to make money. At 110, you don't make any money. Obviously you lose 6. Anything above that, actually you have to add a 606. So if I ask you for the break even, it will be 116.06. Okay? Which is the distance to break even, $16. Okay? From 100 now, it has to go to 116. So the stock has to go $16 more, which represents 16% increase. Okay? So that's some of the parameters, and that's question 2 of the derivatives. Okay? Then we'll continue with the last question, almost done. And the last question, it's going to be basically a financial analysis. That's from lecture, April 18th lecture. And the financial analysis is very simple. This is probably the simplest of all the sections. So you might do this quickly. The first thing you might do just to get out of the way, because if you run out of time, this is the last question. You might do this one first, 25 points. Here I'm going to give you a balance sheet, 2 years of balance sheet, like that, with the assets, liabilities, and equity. And then I will also give you an income statement, 2 income statements, all the way to net income. And basically what you have to do, you have to calculate the cash flow statement. Hi everyone, again I'm sorry the video actually ran out of, but anyway, we're going to the last section, the financial analysis. That's from the lecture 18, April 18th. And basically very simple, I will give you a 2-year balance sheet all the way down. And then also I will give you a 2-year income statement. Those are given to you. And then what you have to do is to build basically a cash flow statement. Sorry, this is the ratio. So I'm going to build a cash flow statement. And here you can tell from net income, I'm going to give you all the right side. So I'm going to give you all this titles, and you have to calculate all this. Study this really nice. Just go actually and just calculate the changes. This all represents the changes in the balance sheet. Working capital activities represent the changes in the short-term assets and liabilities. Investment activities is the long-term assets. Finance activities is the long-term liabilities and long-term equity. And then you get to that. Hopefully that number matches with your cash flow in the balance sheet. So that's basically it. Print that out, write the formulas next to it. But it's important to make sure that the negatives are negatives and the positives are positives. We walked through this lecture, and you should know that an asset goes up, it will be cash negative, for example. An asset goes down, it will be cash positive, and that's it. Then we're going to finish with the ratio analysis. I won't give you all this. I'll probably give you maybe 6 or 7. And you can tell, the major ones are the ones actually you can see both phases, you know that. But, you should bring this sheet with you and know how all these ratios, basically. What I won't give you is the z-score, so don't worry actually learning the almost z-score. But anything, and even the market ratios, you don't have to know that. But I'm going to give you some of the profitability ratios, activity ratios, solvency ratios, liquidity ratios, even trend analysis, growth rates. You should know how to calculate growth rates. So that's basically the exam. The exam actually is basically surrounded around 5 spreadsheets and about 6 questions. So with that, have a nice study, and we'll see you in about 10 days. Okay? Good luck with everyone.